Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Tuesday, the 6th of May, 2025. So let's have a quick look at the disclaimer first before we kickstart today's Daily Dose. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the news flow. I would say relevant news flow, economic data release, and as well as the intraday movement on the broad-based cross asset classes, and as well as I will cover today's key data release as well, more pertaining to the Chinese economy. So let's have a recap what has taken shape yesterday in terms of starting in terms of the movement of the broad-based major US stock indices first. So for yesterday, we start to see the profit taking starts to take shape on the four major US stock indices, especially after the S&P 500, where last Friday it ended last Friday with 9 consecutive sessions of up move. All right, so what we could see is the S&P is down by negative 0.64%, the Nasdaq 100 down by almost a similar magnitude as well, negative 0.67%. The Dow Jones down slightly, a negative 0.24%, and the Russell 2000 down negative 0.82%, pardon me. So what we could see over here is that yesterday I do highlight the chart of the Nasdaq 100, which is considered among the four major indices as a highest beta index. That means once the market kickstart a rally, the Nasdaq 100 tends to be the outperformer among these major broad-based US stock indices. And yesterday I do highlight that the Nasdaq 100 has really shaped a potential bearish reversal chart configuration, which is a bearish ascending wedge, and later I will actually share that it actually reacted accordingly to its not so rosy short-term bearish technical element, which I also highlighted yesterday, and that fall of the Nasdaq 100 is now approaching a rather crucial near-term support level. All right, so later I'll highlight the chart of the Nasdaq 100 once I covered the second segment of today's daily dose, which is the intraday technical outlook. So the key story over here is that we always got to bear in mind that once the US ever since the start of this ongoing, rather complicated way of US tiering trade tariffs implementation and its erratic way of we call it move advocation by its leader, which is US President Trump, it creates a lot of uncertainty about the governance of the US administration, okay, in the free world. So what we could see over here is that every time there is a lackluster movement on the US dollar, that means the US dollar try to actually turn soft, that it will tends to reflect a movement on the broad-based major stock indices. So previously, prior to this implementation of this US complex tiering system of trade tariffs, the dollar weakened, the major US stock indices tends to rise because a dollar weakening represents global liquidity tends to be lesser. But however, now the reverse takes true. Is over here is that the dollar weakens, it boils down in line with the US major stock indices also showing similar weakness as well. So you look at the plunge, the weakness of the US dollar. Yes, the weakness of the major US stock indices yesterday has came in line with the weakness that is being seen on the dollar against the other major currency. So this is the 5-day rolling performance against the dollar against the major currency. Okay, other major currency. All right, so we start to see the dollar yen, the dollar versus the the dollar versus the sterling, the dollar versus the euro, the dollar versus the cat, the dollar versus the Swiss franc, dollar versus kiwi, dollar versus CNH, dollar versus Aussie dollar, dollar versus SGD has been on a path of a downward trajectory since last Friday. Right. So the story I want to share with you over here is the what I call it, the fading off of this what I call US exceptionalism narrative team play that was previously in place since the COVID, okay, since post-COVID, ex-post-COVID. That means we're talking about after March 2020, everyone is only interested in US financial assets. So with that US financial assets, we start to see a very strong outperformance on the US equity versus the rest of the world. And right now, market participants have started to question this outperformance of this US financial assets against the rest of the world, whether is it sustainable given the way US White House administration that is currently running its broad-based governance that includes its number one, US complex way of tiering system, the ongoing so-called cutting off of what I call it operational procedures, and as well as the trimming off of the current US White House administration deemed as excesses in its civil service over here, because we know that there's a couple of we call it a civil service function that has been told to trim down by previously Elon Musk's DOGE department. So that actually exclude we call it that actually potentially could start to see a slowdown in US economic growth, because excesses has been cut in the civil service. So eventually it caused this kind of negative feedback loop in the US dollar, and this negative feedback loop in the US dollar more or less has a negative spillover impact on the US risk assets, which is the US stock. So right now we tend to see weakness in the dollar. It may translate into weakness in the US equity as well. Right. So with this US with this dollar weakness that's been seen yesterday, the major US stock indices taking a back seat, and within our expectation, gold XAU managed to stage a recovery right at a technical, we call it a key technical zone, which is the 20-day moving average, acting as a support level. So that I've highlighted since last Friday, despite the fact that last week we see gold turn a bit of weakness, but this weakness doesn't actually alter the short and medium term uptrend phase of gold. So let me share with you the gold price movement yesterday in terms of the daily chart. So very clearly, it managed to stage a rebound right exactly at the key technical support level, which is at the 20-day moving average. Okay, so this gold over here. Okay, so let me put it, let it right now. This is the 20-day moving average stage bullish reversal, and this move from the all-time high in 22nd of April, that is 3005, all the way down to 1st of May, so that's close about a week. So we can say that this is a bullish flag breakout over here. Okay, for gold. Okay, resuming its short to medium term uptrend phase as it continues to trade above the 20 and the 50-day moving average. So this also based on the intermarket correlation that we start to see weak dollar translate into weak US equity prices, then led to we call it a strong movement in gold price XAU/USD right at a key technical element, which is the key rising 20-day moving average, where it staged that bullish reversal and it broke above this bullish flag formation that was previously in place since about 5 days ago, after it's hitting a fresh all-time high of 3,500 on 22nd of April. So what we could see right now over here, it seems to us that market participants are now also getting a bit of we call it a bit of questioning the 4 weeks of rally in the major US stock indices, whether this is a genuine rally or a dead cat bounce. So based on yesterday's price action in the intermarket movement, it seems to me that market participant now is placing a higher probability that the rally that is being seen 4 weeks ago in the major US stock indexes is likely to be a dead cat bounce. And do not forget over here is that yes, we may start to see a lot of optimism regarding about this trade deal negotiation that Trump's proudly said that countries came to US to actually in a way that back for some kind of trade deal talks to be held between US and the respective country, especially Japan had just concluded its second round and now moving on to the third round. But bear in mind over here is that irregardless whether this trade deal negotiation will be successful or not, tariffs will be still in place. It's only a lower magnitude. And don't forget, US right now has a complex steering system. Number one, it has the base rate of 10%. It has a reciprocal rate of more than 10%. So that is depending on the various country trading account, balance of trade account with the US. So the higher the trade surplus it has with the US, the higher the reciprocal trade tariff. And on top of that, these two are country based and reciprocal, and the non-country based is sectorial and product tariffs. That means, i.e., automobiles, which is 25%. Then we have aluminium, and right now, Trump yesterday is floating the idea of taxing 100% tariff on foreign movie or films production. So that is across the board, and it's not country based, and it will apply irregardless whether the trade deal, ongoing trade deal, is successful or not. So how do we know that? Yesterday, there's this news flow reported by Kyodo News, KYODO News, stating that according to some of their sources, saying that US actually rejects Japan exemption from the reciprocal tariff. So we know that the second round of trade deal talks between US officials and Japanese officials concluded last week, and this particular situation over here is that at this moment in time, there is US refuse. Okay, give me a minute now. What's going on here? Japan's full exemption, not only on the 10% reciprocal tariff, but a country-specific tariff in recent negotiation. All right. So what US offer is only a potential reduction, only a cut in the 14% country-specific tariff. All right. So, and very obvious, the US side stressed in the second round of negotiation that it will consider extending the 90-day suspension on the reciprocal tariff that it has, or lowering the 40% tariff depending on the progress of the talks, according to the sources. So 40% tariff is the reciprocal. So the base rate will still remains, and the automobiles, or what, the 25% plus, will also still remains. So net overall, right, it still will be a potential negative impact on global growth. All right, so with a potential negative impact on global growth, that means, i.e., that 4 weeks of rally that's being seen in the major US stock indexes is too optimistic to say that profit growth will continue to increase in S&P 500 company. And yesterday, we start to see one of the major automobiles company in US, Ford, in its what I call it earnings release conference call, actually post outlook and sees a 1.5 billion hit from Trump tariffs. All right, so Ford company, which is one of the major automobiles US companies, suspend its full year financial guidance due to President Trump auto tariffs, okay, which will reduce 2025 adjusted earnings before interest and tax by about 1.5 billion, which is pretty much significant over here. And also, according to this Bloomberg opinion piece, so far, okay, what we see is that the current ongoing Q1 earnings result conference call, the mention about this word of recession is the highest since almost 2 years, in 2023. Right, so previously recession, this word recession is not used in the last 10 quarters of earnings release. So it's only that right now you see there's a significant jump, okay, in the mentioning of recession risk in the current Q1 earnings release conference call by senior management of the various company that has really reported their respective earnings, and it stood at 156 based on the calculation done by Bloomberg, and that actually is the highest level seen in the last 2 years. All right, so piece of thought to actually share with you guys over here is that there's a high probability right now that whatever the forex rally that's being seen on the major US stock indices seems to be that it's more like a dead cat bounce rather than the start of a pronounced or pronounced bullish impulsive up move to scale new fresh all-time high. All right, unless what we could see over here is that something drastically changed, which suddenly there will be a total removal of trade tariffs, which based on Trump's administration that they will still maintain certain portion of that this ongoing complex steering system of trade tariffs that they have advocated. All right, another news flow I want to share with you guys or economic data release is more pertaining to the US current state of the economy. Tier 1 leading economic, one of the tier 1 leading economic indicator, which the ISM services PMI, it actually came in better than expected, 50.6, previously was 50.8. In the previous 50.6 was what market is projecting, and 50.8 is the previous month of March, and for the month of April it came in 51.6. So if you look at the trend of the ISM services PMI, okay, give me a couple of seconds to load it up. Okay, over here, so it's still flattish over here. So even though it increased to 51.6%, it's still lower than the previous November, December, January, February month. Okay, so on the average, it's still much lower in the previous 6 months or so. So if you look at the trend, the 10-year trend, all right, it's rather inching downwards since the high that was made in 55.8 in October 2024. So I will say that yes, it managed to actually beat expectation, and it's surpassed the prior March print of 50.8, but the trend is still lackluster. It's not shaping a very clear upward trend. And what's interesting is its sub-component over here, the so-called services price. That means this is the, what you call it, the input price of the company within the services industry that is facing right now, because services PMI measures the services industry in the US. So services industry in the US is facing cost pressure on the upward trend. So cost of doing business in the services industry in the US rose to 65.1, way above 60.9, and also way above trading economics forecast of 61.2. So if you look at the trend over here, okay, give me a couple of seconds to load. Okay, so this is the yesterday's print of 65.1 by the ISM services subcomponent price index rose to 65.1 from March 60.9, and this is the highest reading since January 2023. All right, so that's about 2 years back. And if you look at the 10-year trend, very clearly it's spiking upwards again. So showing a potential major up movement. All right, since the low of March 2024 at 53.4. So i.e. what it means that potentially because we know that services industry constitute or contribute close to 3/4 of US economic growth annually. So there's actually a rising risk that sticky inflation may get impacted or may get inflicted back into the US economy. And when that's happened, the Fed hands will be tight. And with the Fed's hands being tight over here, there could be we call it a hesitance by the US Federal Reserve officials to offer generous interest rate cut if the US economy starts to show signs of weakness in the second half of this year. And we know that Trump has started to show a bit of distaste to the current stance, wait and see stance of the US Fed led by Fed Chair Powell, and we know that sometimes his mind might change again. We know that the last 1 week or so, he decided to say that to allow Fed Chair Powell to stay on his term until next year, before in May 2026, before it ends. So that chatter that he may start to post in his social medias, we call it bashing Fed Chair Powell again, may start to ramp up if the Fed continues to give that wait and see guidance due to US leading tier 1 economy indicator indicating there's a high risk of sticky inflation. So when that takes place, that could potentially start to see another downside volatility movement in the major US stock indices, something to bear in mind up for. All right, so another news flow, another economic data release, more in Asia today, more pertaining to the Chinese economy, will be the Caixin Services PMI. So let me have a quick recap. What is the difference between Caixin Services PMI for China and China MBS Services PMI? So both are considered tier 1 leading economic indicator for China. So the MBS Services PMI is being compiled by the official statistical board in China that comprises more of the large corporation, excluding SME, small medium enterprises. Whilst the Caixin Services PMI is compiled by the it's a private firm. Caixin, Caixin is one of the leading media outlet in China. So it's a private firm compiled services PMI. So, but the Caixin Services PMI includes SME. So some market participants will tend to pay more attention to the Caixin Services PMI because it relates to more of a broader view of the services, the health of the services industry, or even the manufacturing industry in China, to take into account of the survey that is being done on SME corporation operating in China. So the Chinese Caixin Services PMI actually slipped below expectation. So market is expecting 51.7. It came in below expectation at 50.7 for the month of April, and also below 51.9 that was printed in the previous month of March. So the latest print over here is actually a 7-month low. So let me flash the chart for you to see. Right, so the Caixin Services PMI declined to 50.7 in April, down for March 3-month high of 51.9 and below consensus of 51.7, and it marks the softest expansion in the services sector since last September. So that's close to about a 7-month low over here. So given this lackluster reading on the services PMI, what it means that the Chinese authorities, which is still not letting us know what is the kind of physical stimulus that they plan to introduce to the Chinese economy to negate the negative impact of the US trade tariffs being inflicted on China. So they, in the last month or last 2 months or so, they have been ramping up fiscal policy support, but without telling us the greater detail. So given the so-called the current 7-month low of the Caixin Services PMI for April, that could increase the pressure on the Chinese top policymakers to introduce, in terms of timing and in terms of we call it the amount of fiscal stimulus into the Chinese economy. And with that, if you look at the current we call it movement on the Hang Seng indices, I will say that there is no major so-called decline in the Hang Seng indices, which is back from the holiday. Yesterday they are closed for a holiday. So the Hang Seng index is in fact up by 0.6%. The higher beta Hang Seng Tech is only down marginally by negative 0.15%. And the HSCI, which comprises of Chinese stocks listed on the Hong Kong Stock Exchange, we call it the H shares, is up marginally by 0.18%. So there is no what I call it major negative feedback loop being inflicted on the Hang Seng indices at this moment in time. More likely, the current firmness of the Hang Seng indices is likely in anticipation that the China top policy maker right now got to actually faster implement their 2 to 3 months of vocal expression on a, we call it a physical, forceful physical stimulus policy. All right. So that sum up the first session of today's daily dose. So let me now touch on the second session, which is the intraday technical outlook. All right. So with that, let me expand my screen. Okay. So starting with the FX market over here. Okay. So let us kickstart with the euro dollar. So no change on the euro dollar as it continues to trade sideways around the 20-day moving average, and this short-term pivotal support that we have since late last week, 1.1270 slash 1.1230. So this will be still my short-term pivotal support level, and the first resistance level to watch to maintain our intraday bullish bias for today will be at 11360, which is the minor descending trend line that now has starts to be much more obvious since yesterday price movement where it got rejected. Okay, if I could link up the lower highs from the minor swing high of 29th of April. So this is the minor descending trend line that kept the previous bounce since last Friday of not breaking out, exposed FOMC, exposed non-farm payroll, pardon me. So a clearance above 113.60 today on the intraday basis during the European session may expose the next intermediate resistance to come in at 114.25, followed by 114.80. So these are the three intermediate resistance to watch out for in today's intraday bullish bias view on the euro dollar. Only a breakdown below 1.1230 with hourly close below it invalidates today's intraday trend bullish bias view to kickstart another round of minor corrective decline sequence, exposing the next support zone at 1.1220 slash 1.1050, which is the former significant long-term circular descending channel resistance, now turns into a significant pullback support level, this dotted pink line over here. Next up will be the sterling dollar. So the sterling dollar also traded sideways yesterday above the 20-day moving average, which is the short-term pivotal support that we have as well at zone at 132.50 slash 132.05. So still maintaining this bullish bias on the sterling dollar, but it got to break out fast above 133.40, which was the first resistance that we highlighted yesterday as well, where it got rejected at 133.40, hit, didn't break out, and starts to trade sideways. So and that also correspond to this minor descending trend line that is in place since 29th of April. So a breakout with an hourly close above 133.40, that would increase the odds of today's trend bullish bias to expose the next near-term resistance at 134.20, followed by 134.80 next. Only an hourly close and a breakdown below 132.05 that would invalidate today's intraday bullish bias to kickstart another round of minor corrective decline sequence, exposing the next near-term support level at 131.20. A breakdown below 131.20 may see a deeper slide towards 129.90. Okay, 129.90, which is the rising 50-day moving average. I think as a similar support level around the 129.90. So that's for the sterling dollar, still maintaining that intraday bullish bias, but to increase the intraday bullish bias, price action got to break out above this key near-term resistance level at 133.40. Next up will be the Aussie dollar. So the Aussie dollar did a slight pop-up above the 20-day, 200-day moving average before reintegrating back below it over here. And now we start to see the RSI breaking below a parallel ascending trend line, and it also broke down below the 50 level mark, so indicating the lack of upside momentum. So there could be a slight dip again on the Aussie dollar back into the lower limit of this complex sideways range that is in place since 22nd of April. Right, so it's trading this in complex sideways range. So using yesterday's swing high 64.95 as my short-term pivotal resistance level, and due to this not so rosy or bearish momentum reading that's being flashed out on the hourly RSI, we'll flip to a intraday bearish bias for today, but we in a complex range configuration below the 200-day moving average. So using yesterday's swing high 64.95 short-term pivotal resistance level, first support level to watch will be 64.15 level. So 64.15 level reintegrate back below it may take us down lower towards the range, the complex range lower limit or support level. So this is a level. Okay, 63.70. $3.70. Okay, so this will be the level to look out for, 63.70. Below 63.70 exposes 63.40/35, which is confluencing with the rising 20-day moving average. However, a price action breakout above 64.95 will see a potential, we call it minor recovery, exposing the near-term resistance level at 65.20/65.55 and even 65.95 next. Okay, so that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen continues to inch down lower as expected, hit our first support level at the 144 figure level before trading sideways, holding right exactly at the lower limit of this ascending channel from the low of 22nd of April, and as well as the 20-day moving average. So it seems to us that price action still remains lackluster or weak. So first resistance to watch 144.40. With that, I'll have a higher level at 145.20, slightly adjusted lower for the short-term pivotal resistance for today. So using a slightly adjusted lowered short-term pivotal resistance at 145.20, we'll still maintain that intraday bearish bias on the dollar yen. A breakdown below 143.25 may see a further potential weakness to revisit 142 figure level. Right, 142 figure level on the dollar yen. However, a price breakout above 145.20, an hourly close above it, may see the continuation of this ongoing corrective rebound sequence to revisit 14610. Above 14610 may see a further squeeze up towards 14705, which correspond to the rising 50-day, the downward sloping 50-day moving average as well, pardon me, and as well as this medium term descending trend line that I drew from the high of 11th of January. All right, so i.e. in a nutshell, still maintain that intraday trend bearish bias using a slightly adjusted downward short-term pivotal resistance for today at 145.20 for the dollar yen. All right, so that sum up the intraday technical outlook on the major US dollar pair. So let me share with you one particular interesting cross pair to look out for on the intraday basis as well. That cross pair will be the Euro Swiss. So you see the Euro Swiss since the high of 25th of April, it has been trading downwards, and right now it's reintegrate back below the 200-day moving average, and yesterday it reintegrate back below the 20-day moving average and stage a bearish breakdown from the minor trend line support that I drew from the low of 11th of April. So from 11th of April, there was this rebound over here. So this rebound is considered as a dead cat rebound, and with the breakdown of the minor trend line support yesterday and the reintegration back below its 20-day moving average, very likely the Euro Swiss cross pair is now potentially evolving a second another leg of bearish impulsive downward sequence. So using 93.50 as my short-term pivotal resistance level, intraday trend bearish bias for the Euro Swiss. Next near-term support level to watch will be 92.50 followed by 92.05. All right, on the Euro Swiss. Only a push up and hourly close above 93.50 on the Euro Swiss cross pair will invalidate today's intraday trend bearish bias to see another choppy upward drift to retest the 200-day moving average again at 94 figure level. Above it sees a slight push up towards 94.45, which will retest on the 25th of April minor swing high and confluencing with the 50-day moving average as well. Okay, so one interesting technical setup to look at for the Euro Swiss on the intraday trend basis. Okay, now next up will be the major stock indices intraday technical outlook, starting with the Hong Kong 33. All right, so the Hong Kong 33 is now, or the Hang Seng Index now is back from its holiday. So being back from its holiday over here, potentially no clear signs of a bullish exhaustion yet. So so today's low will be this level here, okay, at 22,366. So I don't want to use 22,366 because it actually hit this minor swing low here, okay, exactly at the former minor swing high. turns into a pullback support at 22,380. So that is the current intraday low level that's being seen on the Hong Kong 33, and it ended with a bullish hammer candlestick formation, which is positive. But I don't want to put my short-term pivotal support level to be so tight at 22,380. I'll use a slightly lower level, which also confluence with the lower limit of this minor ascending channel that I drew from the low of 16th of April, and so confluence with this former dotted line here, green line, turquoise green line, which is the trend former minor descending trend line, now turns into a pullback support level, also close to that 22,110. So I'll be using this 22,110 as my short-term pivotal support level for the Hong Kong 33, representing the Hang Seng Index. Still maintain flip to an intraday trend bullish bias from yesterday neutrality stance due to the closure of the Hong Kong stock market yesterday. First resistance zone to watch will be 22,790 / 22,990. Above 22,990, we'll see a further push up towards the next intermediate resistance at 23,360, which is the minor swing high of 31st of March to 2nd of April and correspond to this upper limit of the minor ascending channel as well. Only a hourly close and a breakdown below 22,110 will invalidate today's intraday trend bullish bias to kickstart a corrective decline sequence, exposing the next support level at 21,605, which correspond to the 20-day moving average. A breakdown below 21,605 may see a further potential drop to expose the next near-term support level at 21,180 next. So that's for the Hong Kong 33. Next up will be the Japan 225, representing the Nikkei 225. So the Japan 225, Nikkei 225, the Japan 225 continues to trade in a rather sideways lackluster movement, still holding below our short-term pivotal resistance level at 37,380. So still no change. Still watching the 37,380 as my short-term pivotal resistance level. Maintaining that intraday trend bearish bias, but first support level it got to break down fast will be 36,650 for today, which correspond to this minor ascending trend line that is still in place since this ongoing 4-week of rebound seen on the Japan 225 from the low of 7th of April. So a breakdown below 336,650 will increase the odds of today's intraday trend bearish bias to expose the next near-term support level in first step at 36,200, which correspond with the 50-day moving average as well. However, a price action breakout above 37,380 may see the continuation of this rebound to expose the next near-term resistance level at 38,135, which confluence with the 200-day moving average, and as well as this medium-term descending trend line that I drew from the high of 1st of February. Okay, so that's for the Japan 225. Let us now focus next to the Germany 30, representing the German DAX. So the German 30 and German DAX managed to shape a push up and hit exactly the short-term pivotal resistance that we highlighted yesterday at 33,480. So still no change, still looking for a potential minor corrective decline scenario in our trend bearish bias for today. First support level to watch out for will be 23,070. A breakdown below it exposes 22,685, which is very close to the lower limit of this minor ascending channel that I drew from the low of 11th of April. And after hitting the 22,680, potentially the rally may continue for the Germany 30. All right. However, instead of shaping that a potential minor corrective pullback, but instead it starts to break out above 23,480, then today's intraday trend bearish bias for that minor corrective pullback scenario will be invalidated to see the continuation of the impulsive up move, exposing the next near-term resistance level at 23,920 in the first step. So that's for the Germany 30. Lastly will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to hesitant to face a bit of, we call it resistance at the 50-day moving average, and also our pivotal resistance zone at 41,470 / 41,740. So still no change, still using watching this pivotal resistance zone at 41,470 / 41,740 as my short-term pivotal resistance zone to maintain today's intraday trend bearish bias. First support level to watch will be a zone at 40,690/430, which will correspond very closely to this rising minor ascending trend line from the low of 22nd of April. Only a breakdown below 40,430 may trigger off a much more pronounced decline scenario, exposing the next near-term support level at 39,720, which is very close to the 20-day moving average, acting as a similar support area as well. So that's for the US Wall Street 30. However, a price breakup above 41,740 will see the continuation of this corrective rebound scenario extending to the upside, exposing the medium-term pivotal resistance zone, at 42,080/42,400, which correspond to the 200-day moving average as well. Next up will be the Nasdaq 100. So the Nasdaq 100 continues to inch downwards towards the lower limit of this ongoing minor bearish ascending wedge configuration. So still no change, still using the 20,250/390 as my pivotal resistance for today. Only a breakdown below 19,600 that I could lower it down much lower, all right, to this minor swing high area over here that is being seen on yesterday's middle part of US session, which is 20,080. So still no change on the levels. A breakdown below 19,600 will increase the probability of today's intraday trend bearish bias, exposing the next near-term support level at 19,020/18,770, which also correspond to the 20-day moving average, acting as a support level as well. However, a price action push up and a breakout above 20,390 that would invalidate today's intraday trend bearish bias to see the extension of the corrective rebound sequence extending towards 20,630. Above it may see 21,055 next. So that's for the Nasdaq 100. Let's take a look at the the two key commodities, all right, pardon me. So starting with the gold XAU/USD. So gold XAU/USD shaped the expected recovery, hitting our first resistance level at 3,370 in today's Asia session. And with the hourly RSI now back at the overbought level, there could be a risk of a minor pullback taking shape. So minor pullback, first support level to watch will be at 31,315. So if 31,315 doesn't hold, the minor pullback may extend downwards towards the 20-day moving average, now acting as a support level at 3265, also correspond to the former minor range high of 2nd of May that was acted as a resistance, and in early Asia session yesterday before that bullish breakout takes shape. So this is an important psychological level, which is 32,065. So this level here will be my Titan short-term pivotal support for today in case of any minor pullback that may extend beyond 31.15. So as long as this minor pullback didn't surpass below 32.65, we'll still maintain that intraday trend bullish bias on the gold XAU/USD after 33.70. The next intermediate resistance to watch will be 34.20. Above it may see a retest at the current all-time high level at 3,500 level, which is the 3,500 level. Only a push down and an hourly close below our Titan short-term pivotal support at 32.65 today will invalidate today's intraday trend bullish bias to kickstart another round of minor corrective decline sequence, exposing the next near-term support zone at 31.95/31.62. So that's for gold XAU/USD, still maintaining its intraday trend bullish bias after a potential minor pullback that may occur during the European session because of its overbought reading that's being flashed out on the RSI. Support level to maintain that ongoing trend bullish bias will be our Titan short-term pivotal support at 32.65 for today. Lastly will be the West Texas crude oil. So the West Texas crude oil float up towards the gap down resistance that was being formed during yesterday's Asia session opening because of that much more aggressive output hike done by OPEC Plus over the weekend. So still no change, still looking at 60.35 as my short-term pivotal resistance level, still maintaining that intraday trend bearish bias for West Texas oil. First support level to watch 50.50, which is the minor swing low of 9th April. A breakdown below 50.50 may expose 54.40/53.60 next. Only an hourly close and a breakout above 60.35 will invalidate today's intraday trend bearish bias on West Texas oil to see the start of another choppy corrective choppy corrective rebound sequence for the next intermediate resistance to come in at 62.35, followed by 63.88. So still no change, still maintaining that intraday trend bearish bias using 60.35 as my short-term pivotal resistance level for West Texas oil. So that sum up the intraday technical outlook on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for as we kickstart the European session about 3 or 2 hours from now? So during the European session is rather quiet because all these services PMI data are the finalized one, shouldn't be market moving because the preliminary one has been released about 2 weeks ago. So what we see over here is that will be PPI. So PPI could be a market mover potentially. So that is a cost of doing business. We call it producer price index in Eurozone. It will release at 5 p.m. Singapore time. So market expecting from the year-over-year basis to reduce slightly to 2% from 3% that was printed in the previous month of February. So that could impact the euro dollar as well as the German 30. Then for those who are looking at the Canada dollar and the CAD crosses, 8:30 p.m. we do have balance of trade up from Canada. Then thereafter will be a quiet US session, no tier 1 data to take note of, and also stretching into the early morning session Singapore time, nothing to key to take note of as well. All right, so that sum up today's daily dose of market insights. So I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.